and share these slides. Also, while I'm presenting, I can't always see you because you're minimized. So if you have a question as we're going through the slides, just shout it out loud and proud. You don't have to worry about hurting my feelings, okay? Okay, so the first thing we are going to talk about today is why we study accounting. I know that a lot of you guys are here for business type degree, and this is the only accounting class that you ever plan to take ever. Okay, and that's fine. I'm not going to try and bring you over to the accounting side against your will. But I will warn you about this. I'm getting on my soapbox now because this is very important. Okay. Even if your plan is to become a billionaire CEO and accounting is just something that you have people to deal with. Okay. I have people for that. All right. At the end of the day, it is your signature that goes on all the financial statements. Anything that has to do with the money your company is spending or the the amount of money you're making, you sign an affidavit attesting to the fact that that information is accurate and you are held liable for it. So it is in your best interest to understand this material as best you can and to educate yourself as you go on in your career about accounting matters so that when those people come to you with the financial statements for your signature, you know enough to know when they're BSing you, okay? Because it's your butt on the line. All right. I'm off my soapbox now. I'm just one of the many ways it is my mission to reduce fraud in the world. Okay. Because there are some great accountants out there, but there are also some very shady characters. All right. So, the Webster's definition of accounting is an information system that measures your business activities, processes that information into reports, and communicates the results to decision makers. Okay. So things happen, money changes hands, you're recording that, and then you compile all that information into a report. Okay. Okay. So, um, you've seen those, pictures on the internet, what I thought accounting was, what accounting actually is. That's basically what this picture is trying to tell you. Okay. Oh, did someone have a comment? Oh, was somebody asking where I need to go for where you need to go for the for Pearson support? I'm sorry, that only just popped up. If so, I sent a link in an email, but I will also send a screenshot of where you need to go. But when you click on the Pearson link in your shell, it should be the third one from the top. It will send you um, to that support page. Okay, so anyway, as I was saying, what I thought accounting was, what it actually is. Okay, not a ton of number crunching. You math guys and gals out there, this is going to come as a huge blow to you. Okay, but accounting is 90% um, projection, decision making, figuring out what information is important and what isn't, comparing things. And so we're really only using about middle school level math. We got to learn a lot of rules. Okay. And that can be taxing, but math wise, we're on easy street. Okay. All right. There are two, now that I said the bit 2 slides ago about things happening, we compile all that information and we put it out into reports. Well, we make those reports for two different large groups of people. Okay, we've got our external users and our internal users. Now, those external users are the people who want to buy our stock or lend us money. They're people from outside of our company. Those are the people who, and also government regulators. Okay. Those are the people who are going to be looking at our financial statements, and the people who produce statements for those people are called financial accountants. Okay. On the other side of the house, we have managerial accountants, and those guys create reports for people inside the company. So our top tier management, our mid-level managers, and even our employees. These are the wizards who can tell the future using, all these projections. How can we make more money? How can we reduce our costs? Okay. There are lots of careers in accounting that branch out from these different types, but those are the two main types of accounting information out there. Okay. All right. So some certifications that are out there if you want to increase your credibility. The number one is the CPAs, the Certified Public Accountants. That is the gold standard in accounting. Okay. There are also a number of other certifications that are out there. You can be a certified management accountant, a certified financial planner, a certified fraud examiner. And all these are really good. They definitely look great on your resume, and they will teach you some really useful stuff in your particular industry. But because it's regulated by a government agency, certified public accountants are the highest certification, as it were, the most sought after. Okay. All right. So, and here's the important thing, how the money falls on this scale. So at the top, of course, are your chief financial officers, the comptrollers, which are below them, business analysts, tax accountants, auditors. That's where I came in, cost accountants, and accounting clerks and bookkeepers. I would say that of these professions, the ones most likely to be impacted by AI are your tax accountants, unless you focus in law rather than in the actual tax preparation, and clerks and bookkeepers. Those are probably the areas where AI is going to hit the hardest. The other areas are very decision based. They are, you need that human touch to interpret what's going on in the spreadsheet, not just churn out numbers. Okay. That's just my personal forecast. I am by no means an expert on AI, so please take that with as many grains of salt as you wish. Okay. Data analytics. This is how we process our financial information. And in this arena, AI is so exciting. Up to this point, we're only human and we only have so many hours. Okay. So up to this point, we have relied a lot on sampling and then projecting the results we find in the sample onto the greater population. However, if leveraging AI, we can now look at the entire data set, every sale we've ever made in the 50 years that this company has been around in order to form our models. It's very exciting. Well, it's exciting for me. I don't know. I don't know how you guys feel about it, but it's very exciting for me. Okay. Now, some government agencies you should be aware of. First up is FASB, that is the Financial Accounting Standards Board. This is a private organization that oversees the accounting standards. So the rules that we have to follow, those are generated and researched by FASB. Also, the Securities and Exchange Commission, that's the SEC. They oversee all publicly traded companies. Okay, they're the ones who require that you issue financial statements at least annually if you are selling stocks on one of the public stock exchanges. Oops. In this class, and if you are a financial accountant moving forward, you will follow GAAP. That is the generally accepted accounting principles. And at its core, we will do a much deeper dive on GAAP, but at its core, you need to know that all the information that you include has to be relevant to outside users who might be making decisions regarding your company. So any information that they might need to know to decide whether to lend you money or buy your stock or prosecute you for fraud, all of that information must be disclosed in your financial statements, okay? Your financial statements must be what we call fairly stated. They have to be a faithful representation that is complete, neutral, and free from error. Notice that we didn't say that it had to be 100% accurate. There are oftentimes estimates that have to be used in the financial statements. And when that happens, we have to disclose that, okay? Now, this slide always makes me laugh. Okay, IFRS. This is the International Financial Reporting Standards. Okay, this is a set of global accounting guidelines, and 166 countries have adopted these to help smooth the global market. Okay, there is an International Accounting Standards Board, IASB. Now, these international standards do deviate slightly from GAAP, which is what we use. Okay. And every year we're supposed to tell you guys that, FASB is working on those GAAP standards to integrate them with the international standards. And one day we will be on the international standards. Well, let me tell you that they have been telling students that since I was in school, back when dinosaurs roamed the earth. Okay. And it hasn't happened. And I don't really think it's going to. Okay. Just like we're never going to the metric system. Okay. We just want to be special. So be aware that these international standards do exist. If you become an accountant for a multinational company, you will be producing more than one set of financial statements. Okay, so now we're swinging back to talking about GAAP again. So in order to make sure that we're all using the same language, we have to make certain assumptions, okay, when we're talking about financial data. Okay, so one of those assumptions is this economic entity assumption. This is the idea that the company itself is a separate economic entity. Okay. So it is treated like its own beast apart from the owners. All right. Now, economic entities can be any of these types. They can be a sole proprietorship. That's your mom and pop shop, one owner. Okay. A partnership is two or more owners. And then you have a corporation, which is a completely separate entity for both legal and taxation purposes. It's treated like a person. Whereas with our sole proprietorship and our partnership, that's the company or the part of the company that the partner owns is treated like an asset, their personal asset, a thing that they own like a car or a house. And they don't have a separate tax treatment for that proprietorship or partnership. Okay. Also, if you are a sole proprietor, you are personally liable for anything that your company does. So if your company is a bad actor, then your company can be sued, but also you can be sued personally. Also, with a traditional partnership, the partners are liable individually and collectively. What does that mean? That means if your partner commits malpractice and you did nothing wrong, he can be sued personally, the partnership can be sued, and you can be sued as well. Okay? And then, as I said, a corporation is a completely separate entity, both legally and for tax purposes. Then we have a limited liability company. All right. And it is what it says it is. Okay. So liability is limited to the company. They can't go after you personally, but for tax purposes, your portion of the LLC is your personal asset. Okay. Everything I just said on the last slide is summarized in this table for easier studying purposes. Okay, so there we go. Features of a corporation. Remember that corporation is a separate legal entity. It has a continuous life. So if you sell your shares to somebody else, if they get a new CEO, the company keeps chugging along. Okay, unlike with a partnership where if one of the partners leaves, the whole thing dissolves. Okay. Remember that as stockholders in a corporation, you are not held responsible for the things that corporations do. And of course, there is a completely separate tax treatment for that. Okay, so when a company starts out, the incorporators have to get a charter from the state in which they are incorporated. Okay. This just sets out what the mission of the company is, how many shares of stock they're going to start out with. And oftentimes this is when you set the par value for those stock, but we'll talk about that in a later chapter. Okay. This is also where you agree on your bylaws. All right. And then once the company is incorporated and those shares have been sold, each piece of stock that's sold is a single vote for the officers of that company. So the shareholders own the company and they also make decisions through voting. Okay. And then this is words in pictures, as I like to call it, showing you the structure of a corporation. Of course, all the stockholders are technically owning the company. They elect the board of directors. The board of directors nominates the chair. Below them is the president, and then all of the departments. Okay. So, more things that we have to assume when we're using GAAP. Okay. First of all, everything our asset wise is going to be recorded at its actual cost to us. Okay. The going concern assumption, unless otherwise stated, on your financial statements in bold letters, not really in bold letters, but unless it's expressly stated in your financial statements, we all assume that your company is a going concern. What does that mean? It means next year the company is still going to be here producing financial statements. If this is the year you're about to close up shop and declare bankruptcy, it better say that. Or if it's in the next fiscal year, it better say that in your financial statements. Okay. All right. And then the monetary unit assumption. So when we look at a set of financials, we see something that says, sales, 900,000. 900,000 what? Dollars, right? Everything on our financial statements are going to be measured in dollars, okay? No matter what. And if you decide that you don't want 5 million trailing zeros and you want to express the numbers in the hundreds of thousands so that you can type smaller numbers, make sure that it says that in the header to your financial statements, okay? So we all know what we're looking at. Remember that information relevant to the users, okay, has to be there. So we're always looking to make those financial statements as clear and readable as possible. Okay, so if you are a publicly traded company, you are required to submit to an audit once per year. That auditor's opinion is going to be included in your set of financial statements. If you're a mom and pop shop, you might also have to go through an audit if you are trying to get a loan or rent specific items or get bonded, things like that. You may also have to submit to an audit. All right. In addition to the financial audit, the Sarbanes-Oxley Act, which we call SOX, requires that companies also have their internal controls reviewed. That means how well are you safeguarding your assets and trying to prevent fraud? Okay, auditors also look at that. All right, this is my favorite, the Public Company Accounting Oversight Board. We call it Peekaboo. Okay, this monitors the work of independent accountants who audit the public companies. So who watches the watchers? Peekaboo does. Okay. All right. So I told you all that stuff, all of those rules, so that we can finally talk about accounting. So now it begins. Okay, the basis of all accounting is this extremely complex equation. Okay, assets equal liabilities plus equity. Okay. All right. So what does that mean? Assets. These are the things that we own as a company. So our bank accounts, our inventory, the building that our offices go in, the desks and computers, all of those are our assets. Okay. And hopefully we're using those assets to generate income. All right. Liabilities are the money that we owe to other people. We call them payables, but these are our credit cards and our loans, the salaries that we owe to our employees. I will talk more about this later, but when you're paying your employees on a Friday, but they've worked Monday, Tuesday, Wednesday, Thursday, leading up to that day, all that time, they're building up hours that they've worked and money that you owe them. That is a payable, salaries payable. Okay, so equity is the amount of wealth contained in the company. Another way to look at it is the owner's claims to the assets of the company. Okay, so there are two parts of it. There's contributed capital. So when you start up a brand new company, you need to have some money in the bank for the company itself, and you might contribute $30,000 in cash. That is your contributed capital. All right. You also get contributed capital when people buy your stock. Okay. Retained earnings is the money that is left over in your company after you've paid out any dividends. So you make money throughout the year selling your goods and services. You subtract out all the expenses. You decide to throw some cash to your stockholders. Whatever's left over goes into the company's bank account as retained earnings. Okay, those are the two parts of equity. So your equity increases when people put in money, either through revenue that's, from your daily business, or when people are contributing money to that capital. All right. And equity decreases when you pay out dividends to your shareholders or when you have expenses of various types. So you can expand that super complex equation into an even more complex equation. You have assets equal liabilities plus equity, but equity can be broken down into common stock minus dividends plus revenues minus expenses. Okay? All right. So, step one as accountants is to analyze a transaction. So anytime money changes hands, as far as your company is concerned, if somebody buys something from you, if you purchase something, if you're paying your rent, something happened, and money changed hands. Okay, that is a transaction. So the first thing we have to do is figure out which accounts are impacted by this transaction. Then we decide if the account is going up or going down because of this transaction. And then we have to make sure that our equation, accounting equation, remember that assets equal liabilities plus equity, we have to make sure both sides are in balance. Okay. All right. We're going to look at some examples of this. All right. So in transaction one, Sheena Bright contributes $30,000 in cash to Smart Touch Learning. $30,000. That was the same amount I used. It's like I've seen these slides before. Anyway, a corporation in exchange for stock. Okay. So what accounts is that going to hit? Well, first it's going to hit the cash account, and that account is going to increase. Okay. It's also going to hit the common stock account, and that amount is going to increase, and both are going to increase by $30,000. So each side of the equal sign is in balance. All right. So the next thing we're going to do is buy some land. So we're basically exchanging one asset for another, right? The land is $20,000. We're going to lose $20,000 in cash, and we're going to gain $20,000 in land. But notice this asset side still equals $30,000. So it's still in balance with our equity side. All right. Next, we are going to buy $500 worth of office supplies on account. So we're creating a liability. We're not paying out cash for those, right? So we have a brand new asset that we're calling office supplies of $500. And now we have a brand new liability called accounts payable. Okay. But notice that both sides still equal each other. Okay. All right. Next up, we're going to finally earn some revenue. So we're providing training services to our clients, and the business collects $5,500 in cash. So we have $5,500 in cash increase. And then we've got revenue over here on the equity side also increases by 5,500. So our two sides of the equal sign are still going to equal each other. Does that make sense so far? Okay, because I'm telling you, this is as complicated as it gets. All right, next up. So, Smart Touch Learning performs a service for clients who do not pay immediately. So that's a payable to them and a receivable to us, okay? And a receivable for us is an asset. All right, so now we have this brand new accounts receivable, all right? And then we also have some revenue. So this is a new thing that we have to learn, okay? We record revenue. This is a GAAP rule. We record revenue when the goods or services are provided, not when they actually pay us, okay? So we're going to record this as revenue, even though it's an accounts payable. On the flip side of that, we record our expenses in the period they're incurred. Okay, so we can pay in advance for something, but we don't recognize that as an expense until we're actually using it. All right, we will cover that more later. All right, so our next example, Smart Touch Learning pays $3,200 in cash expenses. $2,000 of that is for office rent and $1,200 is for employee salaries. Okay, so our cash is going to go down by $3,200, and then we're going to come over here to equity and we're going to record some expenses. Okay, so we're going to subtract that rent expense from our equity and that salaries expense, keeping both sides of the equal sign equal to each other. Okay, so I'm not going to beat this to death. I think you get it. But we're going to continue on in that vein. Okay, this is a list of all the different transactions that we did, and here's a table summing them all up: assets, liabilities, equity. Okay. All right. Once we do that for a year, then, so all year long, every time there's some kind of transaction, we record it in our computer program. And at the end of the year, we summarize all of that into our financial statements. So let me introduce those to you. This is now, there may be special financial statements that are required for your particular industry, but the basic set that's required by the SEC are listed here. Okay, so we have the income statement. All right, this is arguably the most important financial statement. All right, this shows your profits or losses for the period. All right, and it's set up as revenue minus expenses equal net income or net loss. Okay. Then we have the statement of retained earnings. This is everything that we kept for the company that we didn't pay out as dividends. So we're going to start off with our retained earnings at the beginning of the year. We're going to have whatever net income or loss came from the income statement. Then any dividends that we paid out and whatever is left goes back in to grow the company. Okay. Then we have the balance sheet. Our balance sheet is a representation of that accounting equation. All right. It's expressed as assets equal liabilities plus stockholders' equity. The balance sheet is unique among our financial statements because all the other financial statements cover the entire year. And they will say the income statement for the year ended December 31st, 2026. Okay, meaning that it covers the entire year. But the balance sheet is a snapshot of what was present in your asset, liabilities, and equity accounts on the very last day of the period. It only covers that one day. Okay. And then Your statement of cash flows shows the movement of cash in and out of your company. Why is that important? Because we're looking at how you are leveraging cash versus credit. So your income statement records all of those revenues, even for the people who haven't paid you actual cash yet. Whereas the statement of cash flows shows how much cash you've taken in and how much cash you've paid out. Okay. So, um, those financial statements are what your external users are going to use to make their business decisions about your company. They're also going to be, if you're a publicly traded company, they will also be scrutinized by government entities and your auditors. Okay. All right, so these are the parts of your income statement. Notice for this one, they apparently like to work their accounting department extra hard. So they produce financial statements every month. So the income statement is for the month ended November 30th, 2025. It shows the revenue for the entire month minus the expenses. Remember, we had rent expense and salary expense that we paid. And our net income is the difference between the two. Super complicated, right? We take our expenses, we subtract that from our revenues, and we get our income. All right. Next up, our retained earnings. Our retained earnings to start with were zero because we're a startup company. So we had nothing. All right. We made $5,300. We paid out $5,000 in dividends, so we have left this $300 to grow our company with. All right, stockholders' equity. We had $30,000 worth of stock that was issued. Okay. We also have our net income. We paid out $5,000 in dividends, so we have left $30,300 in equity. Okay. Remember that differs from retained earnings. Okay, earnings are how much we earned for the year, whereas equity is how much is in the company altogether. Okay, now our balance sheet. Notice this says November 30th, 2025. It's not a period, it's just that day itself. We have our assets listed here and the balances in each of those accounts. We have our liabilities listed here and our stockholders' equity and the balances in each of those accounts. It is permitted to either have a side-by-side presentation like this or to have it in one long column, but always important to make sure that your assets equal the liabilities and the equity combined. Okay, very important. All right. And then our statement of cash flows, we're specifically looking at what cash we have collected from customers, what cash we've paid to our suppliers and our employees. Okay. The acquisition of land, we paid for that in cash. Okay. Our issuance of common stock, right? All right. Now, in order to interpret what we see in these financial statements, we have a bunch of different equations that we learn and they tell us different things. Okay. And we can use these performance measurements to compare various financial statements from different companies of different sizes. Okay. So the first one we're going to learn is our return on assets. Remember way back 100 slides ago, I told you the definition of assets. I said, they're all the things that we own, our chairs and our buildings and our land and our vehicles, and hopefully those assets are generating revenue for us, right? Well, that comes full circle. This is a measurement of how well our assets are generating income. All right. And we calculate that by dividing the net income by our average total assets. And the way we calculate this average is we take our assets at the beginning of the year, then we add our end of the year assets and divide that by 2. Okay. So in this example, okay, in its 2021 income statement, PepsiCo reported net income of $7,618 million. All right. Their beginning total assets were $92,918 million, and ending total assets were $92,377 million. So we're going to do a return on assets. We take our net income and we divide it by the average total assets. Remember, that's the beginning of the year assets plus the end of year assets divided by 2. And when we divide that, we get a return of 8.2%. Okay. Is that good or is it bad? It's really industry driven. Okay. So if you sell luxury cars, for example, okay, you've got very expensive assets. And so your margins tend to be more narrow. Whereas if you're selling fidget spinners, you don't have to put a ton of money in to get those items out again. Okay, so when we use this return on assets, we want to compare apples to apples. We want to look at companies that are within the same industry so they are kind of on an even playing field. Okay. Do you guys have any questions about anything that I covered in class today? Like I said at the beginning, I know it's a lot, but we will do a deeper dive on each of these topics as we move along. So I will shut up a second and give you guys a chance to ask questions if you have any. Okay. Well, hearing none, I am assuming none. That is all that I have for you for tonight. Before Friday, I will post some additional videos for you guys to look at. I know that the assignment says that it's due by next Wednesday, but I will extend that out. Please keep me posted on your individual Pearson access. Okay, if worse comes to worse, I will download the assignments and upload them separately outside of Pearson. Okay, all right, have a good night.